The Indian insurance sector is at an inflection point and is expected to be one of the main drivers of global insurance industry growth over the next decade. It is poised to become the sixth largest insurance market by 2032. Gross direct premium of non-life and life insurers has witnessed a steady year-on-year growth. The IRDAI has taken several initiatives to transition from a rule-based to a principle-based system, reduce compliance burden, and facilitate ease of doing business for insurers. One such recent initiative is the re-enactment of regulations governing commission payments and expenses of management of insurers. The new regulations primarily aim to provide insurers with greater flexibility in managing their expenses. Starting with the commission regulations, the product-wise limits on commission payments have been done away with. Insurers can now make such payments in accordance with their board-approved policies and within the overall cap on expenses of management as are applicable to the insured. Also, reward and incentive payments to insurance agents and intermediaries, which were earlier permitted over and above the commission payments, have now been subsumed within the purview of commission payments itself. Similarly, payment of distribution fees to motor insurance service providers would also now be governed by the board-approved policy for commission payments. Moving on to the expenses of management regulations, IRDAI has done away with separate limits applicable to various segments of general and health insurance businesses. Instead, an overall cap on expenses of management has been stipulated for general and standalone health insurers at 30 and 35% of gross domestic premium in India in a financial year. For life insurance business, these limits continue to apply for various categories of products, although higher limits have been prescribed for certain categories. Additional allowances have also been permitted for insurtech and insurance awareness to widen customer reach. Another key change is that insurers are required to formulate a board-approved annual business plan, which would specify projections on capital requirements, quarterly solvency margins, and expenses of management. If the actual expenses exceed the projections by 10% or more, variable pay would not be payable to key managerial personnel in such financial year. Under the new regime, insurers would certainly enjoy greater flexibility in managing their expenses and structuring commission payments, which is also likely to improve the product pricing for customers. Also, removal of product-wise limits on commission payments should result in better innovation and competition within the industry. Smaller insurers have expressed concerns that these developments are more likely to favor larger players. Nonetheless, these changes should enable insurers to be more responsive to market forces and drive growth and innovation in the Indian insurance industry. India remains a vastly underinsured country. While insurance penetration has been steadily rising in India, we are currently at 3% and 1% in the life and non-life space, which is below the global average, particularly in the non-life insurance space. This only means that the opportunity is huge, and initiatives such as FDI liberalization and recently introduced ease of doing business related regulatory changes will aid in achieving the regulator's goal of insurance for all by 2047. Thank you.